Chapter 23 covers the statement of cash flows. In this video, we will be talking about the first learning objective. The first learning objective is just to describe the usefulness and format of the statement of cash flows. In the second learning objective, the second video, we'll be preparing a statement of cash flows. Then we will look at the direct and indirect methods of calculating net cash flow from operating activities, and then we'll get into some of the complications that you can run into when preparing a statement of cash flows. So this first learning objective is fairly brief, just talking about the usefulness and format of the statement of cash flows. So the statement of cash flows is one of the four basic financial statements. The income statement, the balance sheet, and either a statement of stockholders' equity or a statement of retained earnings are all going to be prepared on an accrual basis, which means that you're recording revenues when you earn them, regardless of when you get the cash, and you're matching your expenses against the revenues. So when you look at those three financial statements, you really cannot tell very much information about cash at all. There's nothing on the income statement about cash. There's nothing on the statement of retained earnings or stockholders' equity about cash. And all you can see when you look at a balance sheet is the cash balance at the end of the period. So investors wanted information about a company's cash receipts and cash payments. How much cash came in, how much cash came out, and what the sources and uses of that cash were. So we have information about cash receipts and cash payments divided into operating, investing, and financing activities. Cash also includes cash equivalents. So the basis recommended by the FASB for the statement of cash flows is actually cash and cash equivalents. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash and so near their maturity that they represent insignificant risk of change in interest rates. Generally speaking, a cash equivalent is going to be an investment with an original maturity of 3 months or less. So for the most part, what we're talking about in terms of cash equivalents is where a company is taking their excess cash and investing it in short-term, highly liquid investments instead of just leaving it sitting in their checking account. So in terms of the usefulness of the statement of cash flows, it helps investors assess an entity's ability to generate future cash flows, an entity's ability to pay dividends and meet obligations. It shows the difference between net income and net cash flow from operating activities, and the extent to which those two numbers are close together is considered to be a sign of good quality of earnings. And then finally, the schedule is generally going to have a cash and non-cash investing activities and financing transactions section. So in terms of operating cash flows, we're going to see that there are two basic ways of putting together the operating section. And what's illustrated here is really the direct method, which is the method that is much less commonly used. We are going to go through both of them because while most companies use the indirect method to calculate their operating cash flows, the FASB prefers the direct method. So cash inflows from the sale of goods, from the returns on loans and interest, such as interest, and on equity securities, dividends. Cash outflows to suppliers for inventory, to employees for services, to government for taxes, to lenders for interest, and to others for expenses. All right, so one of the things you might want to note here is that in the operating section, there are some items that might be considered investing and financing activities that flow through your operating section. So from sales of goods or services, that's your operating revenue. It makes good sense that that's in the operating section. But from returns on loans, they're talking about interest revenue, and on equity securities, they're talking about dividend revenue. So typically, you might expect those items to be seen in the investing section, since we invest in notes receivable and we invest in other companies' securities, but under GAAP, they flow through the operating section. That is one of those things that differs between IFRS and US GAAP. Under IFRS, companies have the option of including those in the operating section or in the investing section. Payments to suppliers for inventory, to employees for services, those are obviously operating activities. But to lenders for interest, we're talking about interest expense. That's really kind of a financing transaction, but it flows through the operating section under US GAAP. Once again, under IFRS, you have the option of putting it in operating or putting it in financing. So all of these items that we're looking at are income statement items. In the investing section, essentially, you're going to have cash inflows from the sale of long-term assets and cash outflows from the purchase of long-term assets. So when you're putting together your investing section, you're looking at long-term assets, property, plant, equipment, intangibles, notes receivable, investments in the debt and equity securities of other companies. Financing, the basic ways that we finance our business are through debt and equity. So we're going to look at long-term liability and equity accounts. Inflows if you sell securities or issue notes or bonds, borrowing money. Outflows when you pay dividends, when you buy back your capital stock, in other words, purchases of treasury stock, and then to repay debt. So the principal repayment flows through the financing section, but the interest, once again, is in the operating section. So there are two different ways of putting together an operating section, the direct and indirect method. The investing section, the financing section, those are going to be the same regardless of which method you choose to use for your operating section. So you do want to report inflows and outflows from investing and financing activities separately. So essentially you'll have a little subsection, inflows, and list your inflows, and then a separate section for outflows within the investing section and within the financing section. So basic format is going to wind up looking like this. You're going to calculate your net cash inflows or outflows from operating activities. If the net number is positive, it's a net cash inflow. If it's negative, it's going to be a net cash outflow. You're going to do the same thing for investing activities and the same thing for financing activities. You're always going to do it in that order. Then you're going to take those three subtotals. That's going to give you your net change in cash, and then we have a built-in check figure. If you add that to the beginning cash balance from your balance sheet, you should get your ending cash balance. So the beginning cash balance is going to be the cash balance at the end of the prior year, and then we should compute the cash balance that's reported on the current year's balance sheet. So here is what one looks like. This one is looking at a operating section that is prepared using the indirect method. The starting point is net income, and then we make adjustments to reconcile net income to net cash provided or used by operating activities. Investing, list of individual inflows and outflows. Financing, list of individual inflows and outflows. Take the three subtotals, come up with your net increase or decrease in cash, and then when you add that to the beginning cash balance, you should equal your ending cash balance.